Welcome to this explainer. Today, we're tracking a really fascinating economic domino effect. It's crazy to think about, but it starts over 8,000 miles away, inside the halls of the U.S. Federal Reserve, and draws a straight line directly to a South African petrol pump. It's a story of how a seemingly quiet decision on the global stage literally dictates local survival.
The entire core of our story boils down to an invisible gap. We're looking at the space between the U.S. Federal Reserve pausing their rates at 3.50 to 3.75% and the South African Reserve Bank holding the local repo rate steady at 7%. That precise gap? That is the very thing preventing some severe financial pain across the South African economy right now.
So, here is our roadmap for today. We'll start with the central bank standstill, take a look at how it stops capital flight, how it shields against oil shocks, how it spares the local economy, and finally, we'll wrap up with the bottom line. Let's get into it.
Section 1. The Central Bank Standstill.
You know, it is a pretty rare day in economics when the absolute most powerful action is choosing to do absolutely nothing. But these twin decisions by two major central banks to just, well, sit on their hands, it actually achieved a monumental stabilization of global capital flows. Coming right on the heels of the South African Reserve Bank holding their rate, the Fed's pause provided an immediate, massive sigh of relief for emerging markets.
And pretty much every single benefit we are looking at today flows from that initial rate hold. It stops capital from fleeing back to the US dollar. That stabilizes the local currency. And because the currency is stable, local banks don't have to panic and hike interest rates on everyday people. It's a real win-win-win.
Which brings us to Section 2. Stopping sudden capital flight.
The entire mechanism we're talking about hinges on this exact spread, 325 to 350 basis points. In global finance, capital is notoriously impatient, right? It always flows toward risk-adjusted yield. If the Fed had raised their rates, this gap would have narrowed, triggering a catastrophic sell-off. Investors would have yanked their money out of South Africa and sprinted for lower-risk US dollar assets. Guarding this exact spread is what kept the money exactly where it belongs.
And because of that preserved spread, foreign investors kept a huge appetite for South African government bonds. Right now, those bonds are offering a benchmark 10-year yield near 8.5%. In the current global climate, those are highly attractive real yields for rand-denominated assets. As long as the U.S. doesn't hike rates to compete, that 8.50% remains incredibly tempting for global capital.
This sustained foreign investment directly rescued the rand from some pretty severe volatility. Initially, the currency was teetering near a dangerous R$16.98 to the dollar, but because capital kept flowing in to chase those yields, it dragged the rand back to a much healthier R$16.68 to R$16.80 range. That recovery is the direct result of the Fed keeping its hands off the dial.
Moving on to Section 3, Surviving Global Oil Shocks. Now let's connect this to something we all feel, energy prices. Geopolitical conflict in the Middle East and ongoing shipping disruptions have kept Brent crude prices really elevated, floating between $90 and $97 a barrel. And because global oil is strictly priced in US dollars, a weakening rand would have massively magnified local fuel costs. But because that interest rate hold stabilized the rand, it stopped a global oil crisis from devastating local South African transport logistics, spiking food inflation, and totally draining the consumer's wallet.
I want you to think of the currency exactly as this quote describes it, a mechanical shock absorber. You know when you hit a pothole, the shock absorber takes the brutal impact so the passengers inside the car don't feel it? Well, a steady rand takes the brutal impact of expensive external energy imports, containing that inflationary pressure so domestic supply chains and everyday consumers like you and me don't get rattled.
Section 4. Sparing the local economy.
You know, perhaps the greatest benefit of this policy alignment is what didn't happen. If the U.S. Fed had raised rates, the South African Reserve Bank would have been forced into a defensive 25 basis point hike just to defend the rand. Now, I know 25 basis points sounds small, but that would have immediately pushed the prime lending rate from 10.50 to 10.75%. That is literally like dropping an anvil of debt onto every single household and business in the country.
By dodging that defensive hike, the economy retains its vital liquidity. South African consumer and business confidence is already incredibly fragile. But instead of being crushed, small businesses can actually manage their current debt, consumers can sustain their spending, and critically, monetary authorities avoid throwing sand in the gears of the real economy, which grants the operational room desperately needed to tackle structural nightmares like municipal debt and infrastructure bottlenecks.
And finally,
Section 5. The bottom line. The overarching takeaway from this whole explainer is breathing room. This central bank alignment grants South Africa the critical space it needs to remain resilient. By preserving local liquidity and steadying foreign capital inflows, the domestic economy is shielded from severe demand destruction. South Africa doesn't have to sacrifice its underlying growth capacity just to survive external pressures. However, those dark clouds of global energy costs and geopolitical risks, they definitely remain on the horizon.
So, with global energy costs refusing to drop and geopolitical conflicts continuing to burn, we're left with a really tough, unavoidable question. What happens to the domestic economy when this temporary window of global relief finally closes? It's absolutely the critical metric to watch and one that will ultimately define the resilience of South Africa's economic future. Thanks for joining me for this explainer.